While headlines scream about inflation and interest rates, a silent, powerful shift is underway. Nations you might not expect are quietly, strategically, and massively acquiring U.S. debt. Who are these players, and what does it mean for America's future and the global balance of power? Get ready to see the world economy from a completely new angle. Every day, trillions of dollars change hands. Yet one of the biggest stories is unfolding almost invisibly: the quiet absorption of U.S. debt by global players. This isn't just about money, it's about geopolitical leverage, future influence, and the reshaping of global power dynamics. Who are these silent buyers, and what are their true motives? The answer will redefine your understanding of tomorrow's world. Imagine a global economic chessboard where the pieces are being moved in plain sight, yet no one's talking about the real game. We're about to expose the quiet architects who are strategically absorbing America's debt, not out of charity, but out of a calculated long-term play. This isn't just a financial transaction. It's a silent revolution of economic power, and you need to know who's leading it. Beyond the headlines, the global players quietly absorbing U.S. debt operate with an invisible hand. The surprising truth about why countries like China and Japan are U.S. creditors extends beyond simple trading partnerships. These nations, among others, acquire U.S. treasuries primarily because they are considered safe haven assets. In times of global economic uncertainty or geopolitical instability, investors and central banks flock to assets perceived as highly secure and liquid. U.S. government bonds fit this description due to the stability of the U.S. economy, the size of its financial markets, and the benchmark status of the dollar. This perception of safety allows these countries to park vast sums of their foreign exchange reserves without significant risk of capital loss, even if returns are modest. Furthermore, acquiring U.S. debt plays an intricate dance with currency stability and export competitiveness. Nations with export-driven economies, such as China and Japan, often accumulate significant dollar reserves from trade surpluses. To prevent their own currencies from appreciating too rapidly against the dollar, which would make their exports more expensive and less competitive, they frequently use these dollars to purchase U.S. treasuries. This intervention in currency markets helps maintain a favorable exchange rate, supporting their export industries and economic growth. It's a pragmatic economic strategy, ensuring their goods remain attractive on the global market while simultaneously investing in what is considered the world's most reliable asset class. The motivation is not altruistic. It's a calculated move to maintain economic equilibrium and advantage. However, the landscape of U.S. debt ownership is undergoing a significant transformation, with new power players emerging and shifting the sands of traditional investment patterns. While established economic giants like China and Japan remain substantial holders, there's a quiet rise of non-traditional buyers in the U.S. debt market. This includes an increasing number of emerging markets, from Southeast Asia to Latin America, and particularly large sovereign wealth funds from resource-rich nations. These entities are diversifying their national reserves and investment portfolios, moving beyond traditional asset classes and geographic limitations. The motivations of these new entrants are multifaceted. For emerging markets, holding U.S. debt can be a way to diversify their foreign exchange reserves, reduce reliance on a single currency, and gain exposure to a liquid, globally accepted asset. For sovereign wealth funds, which manage trillions of dollars in assets on behalf of their governments, U.S. treasuries offer a blend of stability, liquidity, and a reliable, albeit low, return. Beyond purely financial considerations, some of these entities may also view significant holdings of U.S. debt as a means to gain geopolitical leverage. Investing in the financial backbone of the world's largest economy can subtly enhance a nation's influence on the global stage, providing a degree of strategic importance in international relations. This shift reflects a broader redistribution of global economic power, where capital flows are becoming more dispersed and less concentrated among a few dominant nations. The dynamic nature of global finance means that even seemingly minor adjustments in ownership can have far-reaching implications for market stability and international power balances, creating a complex web of financial interdependence. This increasing diversification of the creditor base means that the influence over U.S. debt is no longer solely concentrated in the hands of a few traditional economic powers. Instead, A broader array of nations and institutions now hold a stake in the stability and performance of the U.S. economy. This diffusion of ownership introduces new complexities, particularly as global economic conditions evolve. For instance, rising interest rates in the U.S., driven by inflation or monetary policy shifts, could influence these new players' future investment strategies. Higher yields might attract more capital, but if coupled with perceived economic instability, it could also prompt a reevaluation of U.S. debt as a safe haven. Inflation directly erodes the purchasing power of fixed-income assets, potentially making U.S. Treasuries less attractive over the long term for entities prioritizing real returns. The interplay of these factors creates a dynamic environment where the motivations and risk appetites of a more diverse group of creditors will increasingly shape the demand for U.S. government securities. Beyond purely economic considerations, the acquisition of U.S. debt by certain nations can also be viewed through a strategic lens, transcending mere financial investment and delving into the realm of geopolitics. Examining how nations like Saudi Arabia or India might use U.S. debt holdings as a tool for diplomatic influence reveals a sophisticated understanding of international relations. For a country like Saudi Arabia, a significant holder of U.S. debt, these investments represent more than just portfolio diversification. They symbolize a deep economic entanglement that provides a degree of leverage. This leverage might not be overtly exercised, but its existence can subtly shape bilateral discussions on energy policy, regional security, or even human rights. Similarly, India, an emerging economic power, could find that its growing stake in the U.S. financial system enhances its standing in global forums, allowing it to exert greater influence on international trade agreements or climate policies. These debt holdings can thus become bargaining chips in international relations and trade negotiations. While direct threats to dump U.S. treasuries are rare and often counterproductive due to the potential for self-harm, the implicit understanding of a nation's financial commitment to the U.S. economy can foster a more cooperative diplomatic environment. For example, during sensitive trade discussions, a nation's substantial holdings of U.S. debt could be cited as evidence of its long-term commitment to the global economic order, subtly influencing the tenor and outcome of negotiations. This strategic acquisition of debt reflects a long-term vision for reshaping global economic power, where financial interdependence becomes a foundation for geopolitical influence. Nations are not merely investing, they are strategically positioning themselves within the global financial architecture to secure future advantages and project their power. This complex interplay between economics and geopolitics transforms what appears to be a straightforward financial transaction into a nuanced instrument of statecraft. The implications of these shifting dynamics in U.S. debt ownership extend beyond individual nation-states, creating a domino effect across the global economy. Analyzing the ripple effects of shifting U.S. debt ownership on global interest rates and currency valuations reveals potential for both stability and volatility. For instance, if a significant number of these new, diversified creditors begin to alter their holdings based on evolving geopolitical or economic interests, it could introduce new sources of demand or supply into the market, directly impacting treasury yields. An increased demand would push yields down, while a collective divestment would drive them up, influencing borrowing costs not just for the U.S. government, but for corporations and consumers globally, given the benchmark status of U.S. treasuries. Furthermore, changes in demand for U.S. debt can directly affect the value of the U.S. dollar. If non-traditional buyers, particularly those from emerging markets, reduce their dollar-denominated holdings in favor of other currencies or assets, it could put downward pressure on the dollar's exchange rate. This, in turn, impacts global trade, making U.S. exports cheaper and imports more expensive, with cascading effects on inflation and economic growth worldwide. Conversely, sustained demand from a diverse group of creditors could reinforce the dollar's status as the world's primary reserve currency, providing a degree of stability even amidst global economic turbulence. The potential for increased volatility in financial markets is a genuine concern as diverse actors gain more influence over U.S. debt. Unlike traditional, large institutional investors who often operate with long-term, predictable strategies, some of the newer sovereign wealth funds or emerging market central banks might be more susceptible to domestic political pressures or short-term economic fluctuations. This could lead to more erratic buying and selling patterns, amplifying market swings. A diversified creditor base could either stabilize or destabilize the global financial system, depending on the motivations and coordination among these actors. If they act independently and unpredictably, it could introduce systemic risk. However, if their diversified interests lead to a more balanced and resilient demand for U.S. debt, it could contribute to greater global financial stability. The evolving landscape of U.S. debt ownership is therefore a critical indicator for the future trajectory of the global financial system, demanding close monitoring and strategic foresight. Tomorrow's balance, therefore, necessitates a clear understanding of these macro trends as they invariably shape the economic landscape that impacts individual financial decisions. Demystifying how these quiet shifts in global finance could impact your daily life, from inflation to investment opportunities, becomes paramount. For instance, if the cost of U.S. government borrowing increases due to shifting creditor demands, this can translate into higher interest rates for mortgages, car loans, and credit cards for the average consumer. Businesses might face higher borrowing costs, potentially slowing investment, job creation, and economic growth. Inflation, a direct concern for household budgets, can also be influenced. A weakening dollar, potentially triggered by reduced foreign demand for U.S. debt, makes imported goods more expensive, contributing to inflationary pressures. Conversely, a strong dollar, supported by sustained international demand, can help keep import costs down. Investment opportunities are also directly tied to these dynamics. Understanding which nations are increasing or decreasing their holdings of U.S. debt can provide insights into global capital flows and relative currency strengths. Investors might adjust their portfolios, perhaps favoring assets denominated in currencies gaining strength, or seeking opportunities in sectors less vulnerable to interest rate fluctuations. The stability of the U.S. dollar, intrinsically linked to its role as the world's reserve currency and the demand for U.S. treasuries, underpins global trade and finance. Any significant erosion of this status, driven by a sustained shift in global debt ownership, could lead to a less predictable and potentially more volatile international financial system, affecting everything from commodity prices to the cost of international travel. The critical importance of understanding these macro trends extends beyond personal finance. It informs national policy and strategic planning. Governments and central banks worldwide closely monitor these shifts to anticipate economic headwinds or tailwinds. For individuals, this means developing a more sophisticated understanding of the global economy, moving beyond headline news to grasp the underlying forces at play. Making informed personal financial decisions in such an environment requires recognizing that seemingly distant geopolitical and financial maneuvers have tangible effects on one's savings, investments, and purchasing power. A forward look at potential future scenarios suggests a continued evolution in the landscape of U.S. debt ownership. The long-term implications for the U.S. dollar's global standing are particularly salient. While the dollar currently enjoys an unparalleled position, sustained diversification away from U.S. assets by major global players could gradually erode its dominance. This does not necessarily imply an immediate collapse, but rather a slow, deliberate rebalancing of global financial power. Future scenarios might include a multipolar currency system where several major currencies share reserve status, or a significant rise in alternative asset classes as preferred safe havens. The increasing digitalization of currencies and the potential for central bank digital currencies also introduce a new dimension to this discussion, potentially offering new avenues for international transactions and reserve holdings that could challenge traditional debt instruments. The ongoing strategic acquisition of U.S. debt by diverse international actors is more than just a financial phenomenon. It is a profound indicator of shifting geopolitical alliances and economic aspirations. These quiet transactions, occurring daily in global financial markets, collectively paint a picture of an evolving world order. The implications for the United States, its economic sovereignty, and its global influence are substantial. As the world continues to navigate complex geopolitical and economic challenges, the identity of those holding U.S. debt will remain a crucial barometer of global power dynamics and a key determinant of future financial stability. Understanding these intricate relationships is not merely an academic exercise, it is essential for comprehending the shape of tomorrow's global economy and its direct impact on every individual's financial well-being. The silent players in the U.S. debt market are indeed shaping the future.